questions from the shareholders. Are there any questions that they want to ask?
I don't know. Everyone can just write in the chat, write a question, and we'll take it. To begin with, I thought it would be best that you just start explaining.
I understand, but I would rather kind of take at least some 2 or 3 questions and then kind of get it.
All right.
Let me just post.
There's a question for you.
Yeah. Okay, so Nima, let's get on. All right,
Yeah.
I think there are shareholders, right?
Yeah.
So let me just put some questions. There is a question that has come from Birte, okay,
Yeah.
and I know her pretty well, and she has been extremely. I think some of the questions that Birte had asked John Arthur was extremely fundamental. And I will cover her question that had been asked to John Arthur. And John Arthur is the so-called SRK uh, 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 advisor, and who was involved in doing the resource estimation work for Nordic Mines. And his work was put in contrast to FDR's work, and Birte had asked an analytical question as to why has there been a drastic difference between the work produced by John Arthur stroke SRK and the FDR work. And I thought that the question was extremely analytical. I had intentionally submitted the work of John Arthur Stock SRK after FTR had announced their resource related work with Joint Board. And I knew that the shareholders will start comparing the work. And I think John Arthur has also given a reply, but the reply is, might I say, an extremely safe and a diplomatic reply. But we will cover that. I think that is a serious question that she had asked. So we will cover that. And then there is a question saying that, can you explain a little bit about what's the difference between NASDAQ and other lists throughout the world? And if you list on them, what's the advantages by listing on them? Right. Well, let's. This is a very interesting question. Let me cover this before we get into the demerger part.
Yeah, sure.
Okay. All right. So listing in markets, global markets, right? And the choice of selecting a market for listing, right, is a function of what kind of liquidity is available in that market, A, and B, what are, when you say liquidity, it means trading liquidity, okay? It also means financial liquidity pertaining to underwriting, participation by financial institutions, and what have you. So liquidity, covers whether a ready-made access towards capital raising is attractive in that part of the world or not. So that is one function of choosing where do you want to list your asset, right? And the second one, of course, which is of course dependent on the first point, is there are differences in valuation benchmarks uh, by at least uh, you know uh, 20 to 30%, okay, by different markets, because they have different valuation methodologies, okay, that different markets follow, because the addressable market in a particular geography would be bigger or lesser than the addressable market in another geography. So there are valuation methodology differences. So coming closer to Nordic Mines, which is a gold mining asset. Okay, let's first see within the Nordic geography, within the Nordic region, as to say, um, you have examples of dragon mining, which historically has not been listed in Nasdaq at all, ever since there were foreign investors who came in to this asset, right? Point A was, I'll just drift back. Point A was, of course, the retail stroke institutional liquidity available. Number one. Number two is the valuation benchmark and methodologies used by various markets. And three, of course, is the anchor investors' comfort levels. So where are the investors coming from? Okay, and what are their preferences? Would you get traction towards underwriting your listing, all right, from a geography where the investor base, your present investor base, is pretty high? So these are the three factors. Okay, the third one is pretty. It's quite customized. For example, if you ask me, I mean, I don't have any experience of listing assets in Australia or Canada, for the matter of fact. Okay, I have experience of listing assets in Asia. All right. So it is also which market are you comfortable with? Okay, which is the third part, right? So these are the three reasons. Okay, these are three broad points that you take into consideration whilst you decide which market you want to take towards listing, right? And of course there are other complications. Like in our case, there is a threat of Nasdaq delisting us. Okay, which the other day I was explaining it to some other shareholders that there are two kinds of delisting. Just try to understand this, right? Nasdaq today has not delisted us. It has asked for, or it has frozen our shares. And the communication that it has given the board of Nordic Mines via Section 2.8, okay, uh, is uh, is as follows. It says that you have to reapply for listing, which means that we will keep your stocks frozen. And since you guys have changed your board drastically and what have you, and there is no continuity, blah 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 blah, you would have to reapply for listing, right? So reapplication for listing is similar to doing the process, of fulfilling the process and application procedures, which are exactly similar to if at all you were to newly list your company. Okay, but the difference is that your stock prices are frozen and you have to reapply for listing. All right, it's not that you are delisted. There's a very clear differentiation. All right, so it could be quite possible that if there is a situation where Nasdaq says that no, you guys are still violating Section 2.8 and what have you. All right, we have the flexibility to go and reapply for listing in Nasdaq itself. That's exactly what they're saying. Reapply for listing, and inevitably what happens is that an auditor from Nasdaq sides comes in, okay, checks and does a due diligence on the company with regards its finances, its legal structure, okay, and of course its board compliance and management compliance, and it decides whether it should be qualified to get relisted or not, right? So that's the technical definition of reapplication for a listing. All right. Now the danger comes in, okay, if and what is delisting? All right. Now delisting is that Nasdaq says, okay, guys, we have given you lots of chances and we need to delist you, right? Now, and that becomes forced delisting. All right. There are two kinds of delisting. One is forced delisting. Another one is voluntary delisting. Right. Forced delisting is a process where an authority like Nasdaq does not find Nordic Mines fit enough, right, to be listed in the main exchange because it does not follow the rule book. And after having given enough chances, it would probably seem that Nasdaq still believes that there are lots of gaps in compliance of the board and management, so as to say, and thus it will tell you to get delisted, and that is what we call as forced delisting, and that is bad. That is bad because that would invariably come into the so-called history of Nordic Mines as an asset. Simplistically put, if one were to go down and list it in any other geography, right, the question will surely be asked as to why were you delisted by the second biggest network in the world, right, which is Nasdaq, right, and that doesn't really go well with the credentials of the company. It becomes pretty difficult to explain to people as to why were you delisted and why do you want a fresh listing in a fresh market, right? And as I see that, as I see the Nasdaq issue today, in my opinion at least, has got nothing to do with rights issue or FTR, because Nasdaq is not bothered about whether it's rights issue or FTR. That's a shareholder decision at the end of the day. Nasdaq is surely bothered about liquidity coming into the company. Okay, and both the approaches, whether it's an FTR option or a rights option, both target to bring liquidity inside. So as long as liquidity is coming in, Nasdaq is really not bothered whether it's FTR or rights. Okay, so I don't think so. The function of deciding whether it is FTR or rights has got anything to do with Nasdaq delisting, right? Nasdaq delisting, I think, I think fairly and squarely today has emphasis on compliance issues. Okay, compliance to listing rules, compliance to board qualifications, compliance to governance, compliance to management, all of that. Okay, so the forced delisting part is a tricky thing. Okay, it's a tricky thing to all the shareholders. Okay, when it comes to delisting, okay, the priority, of course, Nasdaq has, I mean, historic experience-wise, okay, Nasdaq does have the best interests of shareholders in mind, but given a priority, given one to choose, okay, I think the priority is to first see whether the rule book is followed or not. Okay, and that is important to understand. So rule book exceeds shareholder priority. Right. So if they have to delist, okay, then they would delist primarily on the basis that today Nordic Mines is not following the rule book of compliance. Right. Okay. So one needs to, as I was telling Nima before the conference, I don't have any clarity, right, from the board as to what is that is going with Nasdaq, right, and I say so because the question of getting listed in another market, all right, only arises if Nasdaq is delisting, all right, even if at all there is a chance for a reapplication. Okay, I think we will make an effort for reapplying for listing in Nasdaq, right? But if Nasdaq takes a decision to delist, that's a tricky thing, as I said, and I don't have any information towards the same as to what's really happening at Nasdaq's end. Or I would say that whilst having seeked this answer from the board, I don't really have a concrete answer from the board to this extent. Okay, perhaps this might get covered at the shareholders meeting on the 8th, right? Why does it become very important for us and me as well? Because only if Nasdaq delists is when the Lao Tzu offer is talking about getting listed in another market, right? That amounts to saying that if Nasdaq does not delist, okay, I mean, I don't think so. We're going to go anywhere away from Nasdaq, right? So only if Nasdaq delists is when we are talking about getting to another market, right? And in the case of Nasdaq having taken a decision to delisting, I think we need to be very cautious of the fact that it is better to voluntarily delist rather than having Nasdaq to force delist us. Voluntarily delisting means that the shareholders themselves have decided that there are reasons for getting into a delisting scenario, and one such so-called legal stroke technical reason can be demerger. Okay, demerger is a legal enough and a technical enough reason, okay, to delist for about 4 to 5 months till the point in time you get your demerger prospectus ready and your financials for both the companies ready, dress both the companies, and then freshly list both the companies in the marketplace. That becomes a legal stroke technical and a very legitimate reason to voluntarily delist. Most of the companies that get demerged, okay, take a voluntary delisting for a specific period of time, and then they relist themselves and in newer markets, right? Um, I've also seeked an answer on. I've tried to figure out uh, whether if whether an option, okay, whether it is right. What I've tried to seek is that does the FTR option uh, make Nasdaq more comfortable to make us to open up the shares, right? I mean, so when I asked this to the board, I think the answer that was coming quite categorically is that it really, does not make a difference whether it's rights or FTR. It basically is an issue of shareholder unity, okay, or rather, I would say decisiveness amongst the shareholder to choose one option, and whichever option they choose, then it comes down to following the rule book. So the board has not given me any concrete answers towards that. All right, and I'm as good as anybody else as a shareholder is in this regards with seeking more information. Okay. Okay. So now assume the fact. Now your question that you've asked is assuming the fact, okay, that Nasdaq is delisting us. Because if it is not delisting, then we don't have any reason to go anywhere. All right. But if it is delisting us, all right, then I did like to bring a scenario into the picture where there is a voluntary delisting rather than a forced delisting. Because in a voluntary delisting, it's the shareholders who have decided that they want to delist. So when you go for legitimate reasons, for fundamental reasons, for business reasons, and when you go to any market that you want to go to, it becomes pretty easy to shift from one market to the other, right? Because I can always say that, demerger was the legal reason why we got delisted, and when you get demerged, okay, then you look around for alternative markets which can give you a better valuation. Now, coming down to the question on what are the pros and cons of choosing various uh, 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 various what are the pros and cons of choosing markets. You see it now. Let's come down to the 3 points that I had covered just at the beginning of the webinar. The first point is liquidity. All right. There are, let's come down to real life examples, okay, and closer down to Nordic mines, no, closer down to the Nordic region. In the Nordic region, okay, there are in the Nordic region there are there is an example of Dragon Mine. Okay, Dragon Mining. I personally visited that company. They were nice enough to take me through the entire mine and the processing plant for close to 3 or 4 days. I've met their management. In fact, the plant manager of Nordic Mines is the country manager, okay, this place of Dragon Mines. So Dragon Mines historically has been listed or had been listed or has been listed in ASX. All right. So traditionally, the major two markets, okay, which essentially cover most of the mining assets in the world, okay, are Toronto Stock Exchange and Australian Stock Exchange. Okay. And Dragon Mines was listed in Australian Stock Exchange, and there was an argument because I've spoken to the management over there. There was a debate in the board, which was shareholder driven, because it seems that the board thought, or rather the board of Dragon Mines thought that their market capitalization, okay, in Australian Stock Exchange, okay, was way lower than what the intrinsic value of the asset is. All right. And I believe the investment bankers advising them in the Nordic region, one of the reasons they figured out was because your asset is in the Nordic region, and your market of trading is Australia. there is a loss in sight, loss in mind kind of an issue, all right? That your asset is, your market is not close enough to where the asset lies, all right? Meaning to say that they were saying that you would be far better, coming into and getting listed in Nasdaq rather than in ASX, all right? Eventually, the board has taken a decision in Dragon Minds to get delisted from Australian Stock Exchange and go to Hong Kong Stock Exchange. Okay, so they didn't take a decision to come down to Nasdaq, and I think it's a good decision. They could have gone down to ASX, they could have gone down to TSX. All right, why did they choose Hong Kong? And I'll tell you why did they choose Hong Kong. Okay, they chose Hong Kong, okay, because one of the major investors is a Chinese investor. Okay, and he's comfortable with attracting Chinese liquidity, financial liquidity, retail liquidity. Okay, and Hong Kong is a very liquid market, essentially driven by Chinese money. So if you have more liquidity coming in from the Chinese investors, right, number one, stroke number two, he has the network of getting Chinese financial institutions. They feel that Hong Kong Stock Exchange, the Hang Seng, so as to say, can give them a far better valuation than probably Nasdaq or ASX, right? Similarly, right? Similarly, when I say the Indian markets, it is the same. The logic is the same, right? The logic is that perhaps I'm more comfortable, okay, being an Indian investor. I'm more comfortable bringing in financial liquidity and retail liquidity, right, from the Indian markets, because India traditionally has been a very huge consumer of gold. It today consumes around about 70% of all finished gold in the form of jewelry, right? And that's a huge percentage, right? Gold plays a very vital role, okay, in the fiscal deficit of the Indian government, okay? So it plays a very huge role in the Indian economy, right? So the consumption is huge, right? And obviously, when you're talking about such a large retail base, BSE, Bombay Stock Exchange, is the second or the third biggest retail exchange in the world, right? Because the addressable market is pretty huge. You're addressing a market about 1 billion population, right? And when you talk about gold as a commodity, right, in the Indian markets, it has a lot of importance, right, to the Indian economy. Okay, and the consumable population which consumes gold is also pretty huge. That's one, right? And the second part, okay, of choosing the Indian investor and financial institution base, right, is what we call a scarcity premium. Scarcity premium simply means that when you have a scenario wherein there is such a large consumption of gold in a particular market, but there are hardly any gold mines listed. All right. So when you have huge amount of gold consumption, but hardly any gold mines listed, all right, the premium that you get for listing a gold mine in those kind of markets is pretty good and pretty high. All right, so that is what we call a scarcity premium. The opposite to scarcity premium is what you see in ASX and TSX. All right, in TSX or ASX, okay, what would happen is that assume the fact that Nordic Mines were to get listed in Toronto Stock Exchange. Okay, now just imagine that Nordic Mines will not be even a drop in the ocean, not even a drop in the ocean as far as mining assets are concerned in that market. The far bigger mining assets, whether you call junior mining assets or senior mining assets, lots of gold mining assets. So we will be probably one amongst 200, okay, for all it takes, right? So what kind of traction will you get in terms of liquidity into the market, okay, into this so-called Nordic Mines counter? because for every Nordic mines, there are 10 other Nordic mines existing in that marketplace. All right. The same is the case with ASX, and that is the reason why Dragon Mines selected Hong Kong Stock Exchange. If you go and see Hong Kong Stock Exchange, okay, which is the Hang Seng, all right, Hong Kong Stock Exchange does not have many miners. All right, the Chinese miners have come down and got listed, but there is lots of liquidity coming in from Chinese financial institutions and Chinese individual investors, retail investors in gold mining assets. So I would say that because there are lesser number of gold mining assets listed in over there, and there is lots of liquidity chasing mining assets, your valuation will definitely be better in Hong Kong rather than TSX or ASX. The logic is similar to it, to that of India. Now, what am I simplistically saying? Okay, what I'm simplistically saying is that you see there are future discounting benchmarks. These are unsaid benchmarks, but they're benchmarks in various markets. For example, Nasdaq. All right, if you take Nasdaq, the future discounting, that is the future that is built into the valuation of a particular company, is around about 3 years. Okay, so the forward multiple, okay, will be for 3 years forward. All right. If you go down to countries like Asia, or I would say particularly Hong Kong or say BSE. When I say Hong Kong, it means China. All right, and BSE, and even the US, to a very great extent. You see, the future discounting is a lot higher, right? So for markets like India and China, the future discounting is as good as something like 8 to 10 years. That is, the asset, the built-in future of the built-in valuation, considering the future of the organization or the asset in consideration, is about 10 years, right? So when you have 3 years versus 10 years, automatically the valuation, okay, when your future discounting is a lot more, is higher than if at all your future discounting is less. It's as simple as that, all right? So being a very big retail market, being the biggest consumer of gold in the world, and being and having scarcity premium, all right? For example, let me give you a small example. Go down to a mine called Deccan Mines, DECCAN, Deccan Gold Mines in Bombay Stock Exchange. Okay, just go down to Google, say Deccan Gold Mines, you'll get the ticker, and you figure out. Go down to the website of the site of this gold mine, and you see that this gold mine today is valued at around about 5 times more than Nordic mines, when the size of the asset and the quality of the asset is not even 50% of Nordic mines, right? So here is a clear example: Deccan Mines, okay, valued at around about 5 times more than Nordic Mines is today, right? Where the size of the asset and the quality of the asset, all right, is 50% lesser, okay, than Nordic Mines, and it is listed in BSE, and it is the only mine which is listed in BSE, all right, and this is a good example of what scarcity premium is. Because it is the only mine, it is getting that valuation. Now, if at all I take the same benchmarks and put it to Nasdaq, if at all I were to take the same asset and list it in India, all right, I would obviously get that kind of valuation, because Nordic Mines is a much richer asset than Deccan Gold Mines, all right. So this is one example. Okay. Now coming to a very practical question that that somebody has asked, as to whether you'll have the same flexibility and of course when you list it in the Indian markets, you also have ready-made access to a very huge gold community base. You see, when I say that India consumes 70% of the gold in the world, the trading community is pretty much controlled. The global trading community in gold is pretty much controlled by India. All right. So 70% of the gold produced this way or that way, okay, which is consumable produce, gets into the country. So you have a very big base, okay, very big base of gold community, which is highly liquid, which is highly liquid. All right. And if there is a good production story, then it is absolutely no problem getting IPOs underwritten, okay, by this gold community, which is extremely liquid. All right, extremely liquid. So you would definitely have your valuations underwritten by this community base if at all you have a good production story. All right. Now, coming down to the practical question of whether you would be able to trade in India or not. All right. Now that's a very good question. Okay, and the simple answer to that is India has been a regulated market. All right, like China has. All right. That's why people who want to take Chinese assets go down to Hong Kong, because a lot of Chinese companies also list themselves in Hong Kong. All right. So if you want to have Chinese assets, it's much better to go down to Hong Kong, which is a free market. In the case of India, India is yet not a free market, right? So yes, there will be if I were to list it only in India, yes, there will be an issue. You will have a problem. Firstly, you can't. I mean, you will not be able to trade your shares. Honestly speaking, that is a simple answer. But the solution to that is, you see, I'll answer this question in a very fundamental way. India itself has global companies. Okay, Tata's, Reliance, okay, Infosys, Tata Consultancy Services, Hindustan Company. It's like big time. All right, whether you take pharmaceuticals, healthcare, okay, IT, software, lots of global companies in India, okay, which are listed in India. They have access to Indian investors. What do they do to get access to global investors? All right. So if at all I'm listed in India, and if at all I want Swedish investors to in my company, all right, how do I do that? What I do is I float depository receipts, which is called global depository receipts, GDRs. They are securities which are the same as the underlying stock in the Indian market, and I will list those global depository receipts in Nasdaq, and the Swedish investors can just trade in the global depository receipts like any other share. So global depository receipts trade like any other depository receipts or like any other securities. All right. So if at all I were to list in Bombay Stock Exchange, then I would necessarily have to float global depository receipts in Nasdaq OMX. Okay. And you guys can, all of you guys, even I, okay, can trade the global depository receipts as you would normally trade any share. But what I have also said is that I have also got an option of listing the asset in Nasdaq OMX Dubai. It's not called OMX Dubai; it's called Nasdaq Dubai. All right. It's called Nasdaq. So Nasdaq OMX Dubai is basically in the same network as Nasdaq is, right? So if I were to be listed in Nasdaq OMX and take a voluntary delisting from Nasdaq OMX Sweden, all right, it will be very easy for me to list this asset in Nasdaq Dubai, all right, because it's the same network and it almost tantamounts to automatic listing. Okay, it's because you've already been listed in one network, one major network of Nasdaq. So the listing requirements and all of that, becomes very easy. So it's almost automatic listing in Nasdaq Dubai, provided it is not forced delisting and it is voluntary delisting. Okay, if it is voluntary delisting, then yes, I can more or less automatically get listed in Nasdaq Dubai. Now, why Nasdaq Dubai? This is something which all you guys to understand. Okay, from the gold market perspective, I just gave you a gave you a rationale of where Indian market stands. Indian market and the Dubai market is no different, because the trading is between India and Dubai. So the Indian market is as good as the Dubai market. So if you go down to, if you guys have gone down to if you go down to Dubai, it is the entire Dubai market is controlled by the Indian traders. Okay, the entire Dubai market. Okay, so there is no difference between the Indian gold community in India and the Indian gold community in Dubai. Okay, the same guy who is big in India will also have a presence in Dubai. All right. In fact, it for a lot of Indian community gold traders, Dubai will be a far better market to invest in, because it is a free market. It deals with dollars. Okay, because dirham is pretty much benchmarked to dollars, and all of the Swedish investors and Nordic investors can trade in Nasdaq Dubai as they trade in any other market, including Nasdaq OMX. So if I get the permission from the shareholders, okay, at the EGM, my first preference will be to go down to Nasdaq Dubai and not India. All right, because Nasdaq Dubai gives the platform, the same platform as any other global Nasdaq network does, and you can buy and sell your shares through your broker, Avanza, ACB Banken, Handelsbanken, or whatever. Okay. So there is no difference between trading in Nasdaq OMX Sweden and trading in Nasdaq OMX Dubai, right? But an important part of getting listed in another exchange is the currency risk. All right. So over here, your stock is valued in kroners, and your reporting is in kroners, and thus you're just dealing with one currency, which is kroners. When you go down to an international market, okay, whether it's ASX or TSX or Dubai, all right, or Hong Kong, all right. If you go down to Hong Kong, you're dealing with Hong Kong dollars versus Swedish kroners. When you're going down to Toronto Stock Exchange, you're dealing with Canadian dollars versus Swedish kroners. The same is the case with Australian dollars versus Swedish kroners. In Dubai, it will be basically dirham stroke dollars and Swedish kroners, because dirhams is pretty much pegged to the US dollar. So there is actually no risk between dirham and dollar. Okay, so you are in a sense trading between dollars and Swedish kroners. So that is the risk. Okay, that is the risk that the shareholder has to take. And historically, the dollar has been stronger than the kroner. Of late, the kroner is strengthening, and I think it's a technical technical strengthening. But fundamentally, I believe over a period of time, I think dollar is intrinsically stronger than the kroner. Okay, but fundamentally speaking, I think what really matters, okay, if you go down outside of Sweden and get listed somewhere else, is that you're dealing with currency risk, which is basically the risk which the shareholders have to take. All right. So that answers Marabu's question, right? Let me go down to Birte's question, which is Birte's question was any news about customers for the processing plant? Yeah. Birte, let me take you through this demerger concept. All right. So if you go to the 2013 balance sheet, or rather I would say the annual report, 2013 or 2014, one of the two, right? Quite interestingly, the management and the board then, and out of which I believe Christo Sadamam is the only guy who's common to this board and that board as well. Okay. So I think Christo was involved from 2011 itself, right? So He's been a continuous member in the board for 5 years, 5 to 6 years. And when he was a part in the board as well, right, in 2013, 2014, very interestingly, the annual report of 2013 or 2014, one of the two, has dedicated a good 1 page, okay, on what the board wants to do as far as processing gold from other mines are concerned. Okay, so this is not something which has come out from my mind. Okay, it is a discussion that has already happened historically. Okay, by the earlier boards. Okay, of Nordic mines. Okay, a good 1 page has been dedicated 2013, 2014 on why processing gold from other mines could be considered to be a profitable venture, okay, for Nordic mines as a whole. I have just taken the concept of tolling or concept of processing gold from other mines to the next level of demerge. Okay, so the value addition that I have done to this process is that I've taken that thought and the idea of processing gold from other mines to the concept of demerge. Right. Now, why am I saying that? I'm saying that because um, uh, whilst this discussion was going on, okay, in the board of Nordic Mines, of which I was one of the board members, right? One of the board. So what happened was that invariably I visited. I think Saradi Rajan visited. The whole process started off, Birte, by firstly figuring out technically whether we can process the mines, whether the plant is capable of processing the mines, considering environmental reasons and all of that. All right. And one of the important diligence measures, all right, that came onto the table was the benchmarking done to Dragon Mining, okay, which has its processing plant in Swatliden, and that processing plant had become a non-functional processing plant after Swatliden gold mine stopped gold production. Okay, so they did not know what to do with that processing plant. Okay, much to the same condition as what we are today. Right, that there was no gold to be supplied to the processing plant from the Swatliden gold mine. Okay, so they could not dismantle the plant. So they made use of the plant by doing exactly what Nordic Mines was and is thinking of taking gold from other mines. All right, so they took gold from Endo Mines, okay, which is very near to what's very near to Nordic Mines. They took gold from and Swatliden is in Sweden, and their gold mining properties of dragon mining is in Finland. All right, so they took gold from Endo Mines. They took gold from Finland, that is their own gold mines, and they took gold from Biogdal gold mines. And in total, they aggregated something like 2,000 kilos of gold, and that was the activity. If you analyze the balance sheet of Dragon Mines in the last 2 or 3 years, their mining production in Finland is nothing to boast about. It's almost ending its mine lives. All right. But the tolling business, okay, kept the company running for at least 2 to 3 years. All right. So that was the reason why I went to Dragon Mines, to understand how all this happens. We also went to Swatliden to see the processing plant. And I believe Saradi Rajan had also gone to Biogdal gold mines. And the initial feedback from each of the three, or each of my visit and Sardi's visit, was as follows. Biogdal said that if you have your license to toll, okay, we are ready to give you our concentrate. All right. Dragon Mining said that they would be happy, all right, to join hands with us, and there is absolutely no issue with the economic trucking distance between their gold mines and our gold mines, all right, and so on and so forth. Uh, the study was, or rather, the research was left at that. Because you couldn't do anything more than that. Of course, there is Agnico Eagle as well with the Kitela property, all right, which is a gigantic asset. Okay, it's like probably one of the world's biggest gold properties, all right. And then of course. The demerger concept was being advocated in the to the board, and there were arguments here and there and so on and so forth, right? And then of course, as you all know, I think there was some work done by the Nordic Mines management in terms of literally bursting out the theory of Liva being able to process other people's gold. To start off with, personally speaking, I doubt the confidence of that. I will question the confidence of that effort. Okay. I think that in my view, upfront, I think that was an effort more towards dissuading the concept of demerger to happen, more than an honest approach in terms of figuring out how it can be done. All right. So I will not take that part of the work done by the management very seriously, is because there is some information that I have from the municipality who said that well, we didn't give them the license, we just gave them what they asked for. Okay, so the license was not given by the Finnish municipality, it was applied for. Okay, so they got whatever they applied for. All right. So I would take that with a pinch of salt. Okay, I would still think that there is a huge potential for tolling gold from other properties, and had that not been the case, why should the 2013 report with the then management and board, okay, dedicate one page to processing of gold from other mines? All right. The delay in perhaps we could have even started with Biogdal gold mines the last fiscal year. We did not apply for, fundamentally speaking, we didn't have a license, okay, which allowed us to process other people's gold. Dragon Mine, when they installed or when they established their processing plant, they had a multiple gold license. We didn't have we had a singular gold license. That means that we could only process Liva. So we had to go down and apply for a multiple license. All right. So that is the reason why there was a delay, and we couldn't really get clients because we didn't have a license. And now what has happened is that there is a bit of a dichotomy which has come in terms of the work that has been done in terms of getting some licenses, which personally speaking, Birte, I as a shareholder and as a person who has been close to the asset, I will literally take this with a pinch of salt. I will not take this seriously at all. Okay, I would rather go down and do this work myself, okay, with the Finnish municipality. I mean, just come off it. If the processing plant can add value for other mines in the neighboring region, all right, and if it is good for the entire region, and also good for Liva, okay, and its employability and its economicalness, I mean, why should anybody stop you to get that thing going? Okay, number one. Number two, on the environmental feasibility, the management had already done an environmental feasibility by taking the sample from Biogdal gold mines and Endo mines, and the feasibility samples had been tested and everything was okay. So I don't think so that is so getting getting the when I asked Dragon Mines, another information, when I asked Dragon Mines that will you give us the gold, they said that giving the gold is not a problem, but since everybody in that area, in the region, know a lot about Nordic mines, they said that they don't know how, even that's what their concern was. They didn't know that how, even if at all Dragon Mines gives us the gold, even if at all Biogdal gives us the gold, they didn't know how you can turn around that mine. They said that tolling and processing is really not something that can really turn around Nordic Mines as a company. So they thought that yes, it could add value here and there, it can add incremental difference, but can it add big bang and very serious difference in terms of turning around their point of view? Or no, still you will have a situation where you would have to make sure that Liva produces gold and supplies gold. So the question that you are posing is answered in this way, that you have to make sure that Liva produces gold. Okay, otherwise tolling does not make any difference. It's not a self-sufficient business model to make Liva exist. All right, so you have to make sure that Liva produces first. And only if Liva produces, okay, the economics of the processing plant is good enough to stand alone. If at all Liva does not produce, okay, even if at all you take gold from other mines, it does not make a difference. But specifically speaking, it is my view, Birte, that that a lot of bad blood had gone down in the last so-called interaction between whether FTR is good or demerger is good by Lao Tzu, blah blah blah. And in that, I believe that the proposition that was put by Legacy Hill Resources was extremely one-sided. It was a very biased approach. You could smell it, that there was something fishy in that. Okay. And I believe some of the shareholders did get in touch with the Finnish municipality, who said that, listen, we are not over here to dictate the show. We have given whatever Nordic Mines has applied for. So they applied for X, they got X. Okay. So I have absolutely no doubts in my mind that processing gold from other mines is a very viable possibility, a very viable project, but it needs to be blueprinted out. It's still in its early stages. It's still in its early stages. We are still in the still in the world of, even till today, still in the world of deciding whether we want to go for FTR, we want to do rights, blah 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 blah. This discussion that I am having with you should have happened 6 months back or 7 months back. All right, and by this point in time, we would have had all the answers. So if that answers your question, okay. But the potential for processing gold from other mines, bit, is huge. It's really huge. There are only three. Or rather, I would say four. I would say four Dore bar manufacturing facilities. One is Agnico Eagle, which cannot render its services to third parties because it has got enough of its own produce. So take that out. Okay. One is Boliden, which again has is practically runs in full capacity. So take that out. So the only two processing plants which don't run in full capacity is Swartleden processing plant of Dragon and the processing plant of Liva. And if you take apples to apples, I believe the processing plant of Liva is much better, is much bigger in size, and is a lot more capable, okay, in terms of processing a lot more output than Dragon Mines. If Dragon Mines can source and process 2,000 kilos, simple question, why can't Nordic Mines, right? So, but again, reiterating and repeating that that is not enough. You would have to see that Liva produces gold. And yeah, so John, to all, at the end of still no stakeholder had been found. Though, do you have such contacts? Well, yes, I've already said, spoken to Dragon Mines. That was my effort. I believe we've spoken to Endomines, but that was the point in time when Endomines was producing gold. Well, Endomines has forever been chasing Nordic Mines to supply their gold. But you know, today it is slightly it is obsolete because Endomines doesn't produce gold. And Saradhi Rajan had talked to the CEO of Beogdal Gold Mines, and they had also conceptually agreed that they can do it, no problems. After they said that they could do it, it's only then that the first thing that we did, early part of January 2016, is that we bought samples from Endomines and Beogdal Gold Mines and tested, okay, for feasibility at Liva, and it succeeded. Everything was hunky dory. All right. So that's where it is. Okay. So I guess let me now spend some time on the demerger part. Okay, because as I said, the processing gold from other mines was always something that people had already thought of. All right. So it was not a rocket science. Okay. But when I learned that processing gold from other mines will only incrementally have a difference to making Nordic Mines a feasible gold production business. Did I think about the next step, the next orbit, the next stage, which is the demerger stage? Okay, and I'll let me spend some time on that. Right. Uh, so 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 let me first tell you what is the. I have always been saying that this is not, in my view as an investor, this is not a mining. Uh, uh, I mean to say that the fortunes of Nordic Mines. See, the problems of Nordic Mines are very personified. Every Tom, Dick, and Harry knows it. Okay, in the mining community in Nordic. All right. And uh, From 2011 to 2013-14, it has always been marketed to the public as an equity play. In simple words, that it has been an equity story. It has not been a production story. Okay, up till now. One of the reasons why it could touch $600 million was it was played upon as an equity story, okay, and not as a production story. All right, this is another thing that the information disseminated was completely wrong. Um, the point being made is that, in my opinion, all right, yes, the simple truth of the fact is that the cash costs currently at Nordic Mines, with today's gold price, all right, just does not have any safety margins available, okay, with it to be made feasible or to be made into a production story, okay. And I think that from 2011 to 2015, a lot of very intelligent mining minds, okay, have come in and gone. All right. One amongst them was, of course, El Dorado Gold Mining, which was the 10th biggest gold mining in the world, which had put in as serious as $40 million for 13% of the company. Okay. And when, of course, the stock the gold prices came down and the cash cost was higher than the gold price, there was a lot of study. There was a very detailed work done by the then management, Ebly Bank and El Dorado, to figure out whether there is any light at the end of the tunnel in terms of, improving the head grades from a mining perspective, blah 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 blah, and getting on with the game. After all, it was about saving the $40 million of investment. And if El Dorado, a company which is like 10th biggest in the world, took a decision that, nothing much can be done with this mine from a mining perspective, okay, and they chose to write off $40 million, okay, rather than spend any more money towards recovering the $40 million. Now, guys, I think let's respect that part of Nordic Mines phase. All right. SRK has done lots of work on the mining front. Okay, I think SRK has been involved right since 2012. From 2012 to 2015, at least a couple of reports to 3 reports of SRK have come in, and all the reports are varying reports. All right. Okay. The last report was varying from the one before that, and that was varying from the one before that. So it is a challenging mining geology. There's no question about it. All right. So to think that John Boyd will come down out of planet Mars, all of a sudden spend 3 weeks and say that blasting will now improve my head grades from 0.8 grams per ton to 1.8 grams per ton, is basically living in a fool's paradise, according to me. All right. And my point is very clear. My point is, I'm coming from the perspective that, okay, maybe you're looking at the problem from a different perspective. Maybe mining is not the problem. Maybe mining is not the problem. Mining is what it is. Yes, you can deploy creative mining techniques. You can have productive infill drilling. You can have efficiency in blasting, but how much can it increase at the end of the day? You can have laser sorting at the processing plant. Okay, how much can it increase? In my view, incremental activities, okay, like these ones, can incrementally increase the head grade. Okay, it is common sense. It does not require mining sense. It is common business sense that if at all today you are at cutoff of 0.6 to 0.9, all right, the maximum that you can basically think of going, okay, through mining techniques or efficiency techniques, okay, related to mining, is round about 1.1 and 1.2. Okay, and that's exactly what the head grades that Nordic Mines had achieved in 2012 and 2013, although it was not economical. So the idea is that, is there a business case which can make Nordic Mines economical at 1.1 or 1.2? But to think that your mining model, okay, is going to change fortunes for Nordic Mines by increasing the head grades many times over 0.8 or many times over 1.2 is slightly unbelievable stuff. All right. So that is where I'm saying that probably, okay, the problem definition itself is wrong. The problem definition is not to figure out your grades, because I think your grades can incrementally be increased by increasing mining efficiencies with regards, be it sorting or be it effective reserves upgradation by infill drilling here and there, or be it blasting. All right, I think the real question to ask is the problems over the ground and not the problems under the ground. Okay, under the ground the mining geology is what it is. You can restructure the geology in the way you want to. Okay, SRK will do it in a different way. John Boyd will do it in a different way. Probably they will come out with different outputs. Okay, but the underlying risk is the same. You're trying to restructure the geology which is under there's an uncertainty over there. Okay, there's an uncertainty over there. Okay, and that is the reason why I think that the laser sorting part is a pretty good thing. Okay, that the last management embarked upon, because it is over the ground. Okay, the observations are empirical. The observations are certain. You see what you get. Okay, And as Birte also laid out in her email to John Arthur, the difference between John Boyd related work done by FTR and John Arthur work done in conjunction with SRK, the difference was sorting. Because John Arthur stroke SRK had baked in the sorting work done by Peter Kuiper and Legacy Hill Resources, and because the sorting work was baked, okay, the cutoff grade comes to around about 0.1 to 0.3. In the John Boyd work, okay, they have not taken sorting, and that's the reason why they've got a different result. All right. So it really depends upon what you want to believe in at the end of the day. All right. And as far as I'm concerned, before even getting down to whether John Boyd is correct or SRK is correct, okay, I want to understand whether I have a business model which is independent of mining models. Can I reduce down my risks and change or establish a business case of whatever happens over the ground and not under the ground? Because over the ground I can see, under the ground I can only guess. Okay. Now what happens over the ground? All right. Over the ground, we all know that the plant is an inefficient plant. Okay, we know that. Okay, we know that today the plant, even at what, something like 1,500 kilos an annum annually, you would just be satisfying something like 25% of the capacity utilization of the plant. The plant is far bigger than what the mine can produce at this point in time. And that is the reason why you're saying that you want to process gold from the other mines. All right. Because at the end of the day, you want to make sure, okay, that the mine is efficient, that the processing plant is operating at a utilization which is almost full. All right. So it proves the fact that the processing plant, unless and until it gets utilized, okay, to its capacity level, it will almost or always operate at an inefficient level. Okay. And that is the reason why demerger comes in. Demerger is not a mining concept to start off with. Demerger is a financial concept. It's a hardcore financial concept. So demerger argues with the fact, can I do financial creativity? Can I do financial re-engineering? Okay, to bring cash costs down. Simplest. So the earlier 2011 to 2016 work is, can we do mining re-engineering or mining restructuring? All right, to increase head grades and thus get into a effective mining business case. What I'm saying is that I don't want to be mining dependent. I want to be business dependent. My mining model should be driven by a business case and not the other way around. I think from 2011, even this Boyd work, you know, I think a lot of work between 2011 and 2015-16 has been mining work driving business work. That is a mining case, okay, led business case. Whereas I want to say that it should be a business-led mining case. Thus, I'm trying to argue whether at a financial level, strictly at a financial level, okay, can I do something over the ground which can make the mining case more efficient? Okay. So what is the business rationale? Okay, the business rationale is as I said, is financial, and I have in a sense also posted to all what this means. See, guys, allow me to spend some time on it, because it deserves that time. Okay, so don't get bored, because this is important to understand as a concept, though I will cover that in the EGM as well. But yeah, so listen, why don't you guys, and why has anybody asked a fundamental question? Okay, the fundamental question to ask is, why should a gold mine, and any gold mine, manufacture gold? That is, manufacture doré bars, when it can stop at the ore that produces gold. So in my fundamental view, okay, why should Nordic Mines get into the brave business model of manufacturing doré bars? Why can't it be in the business of just manufacturing the ore that produces gold? That means that get into the business of selling the ore that produces gold and not manufacturing the gold. And that is where you should go down and see the business model of Dynacor Gold Mine. Dynacor Gold Mine was not a demerger model. Dynacor Gold Mine was what is the business that a processing plant is into. Okay, and so in Dynacor's case, there is, I'm just taking Dynacor as an example because it becomes simple to explain, right? Peru is a fragmented market. There are many small miners, right? And Dynacor aggregates gold from, I wouldn't say aggregate gold, but aggregates ore from many such miners, okay? And then it does the processing plant business in its processing plant. It's the only processing plant, it's the biggest processing plant in Peru. And so importantly, what I'm trying to say is that those many small scale miners, they sell the ore to Dynacor. And what I'm trying to say over here is that Nordic Mines can also sell the ore to the processing plant if at all you demerge it. Okay. Now it's a different thing to ask as to what happens after that, and we'll come down to that. All right. So why should the gold, Nordic Mines is not in the business of manufacturing doré bars. Nordic Mines is in the business of producing a relatively high quality grade of ore. Okay, that is what it is in the business on. Okay, and that is where I'm basically saying that, you know, so the first question that I ask myself is that gold mining, okay, should the gold mining play is all about producing good quality ore, okay, and the manufacturing play, okay, is to figure out how to efficiently manufacture doré bars. Okay, so so the processing plant, that is the manufacturing of doré bar business, is meant for players who want to consume the doré bars. Okay, and that's the reason why we call it as a downstream business. It is the business closer down to the end consumer. Okay, it's a business that is meant for the player in the mining value chain who wants to consume the doré bars. Okay, Laiva, gold mining doesn't consume doré bars. It is in the business of selling the ore. Okay, more efficient is the ore, which means that higher the grade in the ore is, the more that you get paid for. Okay, by the processing plant who will be the buyer of your ore. Okay, now, and that is where you have a demerger arbitrage. You have an arbitrage at play. This is a very important concept which I did like to explain. All right, and that's the reason why I kind of said that it's got nothing to do with mining. This is a pure financial play, okay, in terms of reducing down risks and bringing up the certainty of the business model. And you will see that once I've explained to this, when I go down to the mining model, that will answer Birte's question as who is correct. Okay, so between John Boyd and SRK. Okay. So the next question that I ask myself is that, is there a demerger arbitrage? If there is no demerger arbitrage, there is no demerger business case. And arbitrage means margin difference. Is there a substance? Okay, then you might argue whether the difference is significant, meaningful, not meaningful, okay, and so on and so forth, right? But if there is a significant demerger arbitrage, okay, then the efficiency of demerger is very high, because what we say is the synergy value, okay, the demerger synergy value, which we call as the reverse synergy. The reverse synergy value is very high. And simplistically put, the arbitrage, okay, between the margins generated for Laiva, the mining business, and the processing plant which buys the ore from Laiva, okay, is very huge. The difference is very huge. And what is the difference? The difference is that the processing plant operates at 3% margins. And that is where I brought the Dynocor business model into place. Dynocor business model operates at 3%. And it is not operating at 3% because it wants to. Whereas I think somewhere FTR is saying that it is a very low margin. I think they just don't understand a shit about the processing plant business. It is not the margin. The margin is not operating at 3% because they want to. It's inefficient. Because 3% is the industry margin. You go down, if you take 3%, is in fact it is even lower than 3% if at all you're lowering down your risk. In the case you are buying the ore and processing the ore, the benchmark is around about 3%. And such are the margins all around the world. It is not Dynocor as such. All right. So what is proved is that there's a demerger arbitrage. The processing plant business operates at 3% margins, shareholders. Please understand this, because it operates at 3% margins, you get a chance to operate the mine at far higher margins, which in my calculation comes to around about 38%. Okay. So when there is a difference, when there is an arbitrage difference between 3% and 38%, then the earnings per share, if you blend it, is a lot higher than what it is today. In simple words, the sum of the parts is much greater than the whole. Now, nobody has understood that. Nobody has understood the fact that you should separate the two assets, because the two assets cannot be mixed with each other. One operates at 3%, the other operates at 38%. When they are mixed, what happens? When they are mixed, you see what happens is different asset classes having different business economics and margins. Asset classes have different economics. You guys are investors. When you invest in risky assets like stocks, the returns of stocks are a lot riskier and thus higher than when you invest in bonds. Okay? So the processing plant business, treat it as a fixed income bond existing at 3%. Whereas the risky asset is the mining asset, which gets freed up, which gets completely freed up post demerger to operate at far higher margins. Now, exposing the processing plant margins at 3%, guys, and then enables the mining margins to surface up at 38%. And that is the reason why the earnings per share blended is greater than if at all it was not demerged. Okay? In the if at all the assets are not demerged, okay, in the non-demerged state, the mining activity today, this is very important to understand, the mining activity in addition to itself is also funding the plant activity. There are two things happening over here. One, the value of capital contribution towards funding plant activity is not given to the plant, is not given to the mine. Thus, two, because the total capital efficiency to fund both mining and plant is suboptimal, the mine also loses its intrinsic value. And that is the reason, friends, today the value of Laiva mine given by the marketplace, the value given by the marketplace to Laiva mine, only the mine, not the processing plant, is 0. You are only getting the value of the processing plant if the processing plant is not operating. You're just getting a dead asset value of a non-operating asset called a processing plant. Even in the last 1 year, when you see the stock prices are in and around 0.60 to 0.72, all right, about 70 to 80% of that stock price is the plant value and not the mine value. Today, and even when the price was 0.60 to 0.72, the shareholders are getting completely negligible value on the mine. And that is the reason why you should demerge, because the demerger surfaces out the true valuation of the mine. Why does it surface out the true value of the mine? Okay, and that is where we go down to the technical mining rationale, and that would possibly answer Birte's question to John Arthur as to which one is correct. Okay, so when you go down to, when you have this business rationale established in your mind, okay, then you go down to what should be your mining model. Okay, then the focus of the mining model, okay, is generating safety margins. Safety margins is not a mining issue. Safety margins is a business issue. What is the business definition of safety margins? You see, what do you mean by safety margins? All right. Simplistically put, if I go today to SEB Banking or Handelsbanken and say, I've got Laiva, I want to pledge it, how much loan can you give me? Okay, and this is what my resource statement is. Okay, the resource stocks reserve statement is, the value of it should be around about, say 1 kroner, or say 100 million or $100 million. Can you give me about, say, $40 million of loan? Okay, theoretically. They will first see what is the gold price. Firstly, they will see that it is not a producing asset. Okay, so they will discount their risks. Okay, then they will see what is the gold price. Okay, and when they see that the gold price is $1,300, no risk hedger, no risk modeling will be done at $1,300. They will further reduce down the gold price to answer, what if the gold price was at this price? Can the mine sufficiently produce gold? So at today's price of $1,300, the market is indicating that our safety margins should be calculated at around about $1,100 an ounce. Okay, so higher the gold price, higher are the gold prices to be measured for safety margins. So my question that I have to ask myself, okay, is that, can I produce? Is there a feasibility? Is there a gold production story feasible at $1,100? All right. So when you say $1,100, okay, then the bank will say, fine. So we would expect something like what? A 30 to 40% margins, because that is good enough for us to understand how much of debt that we can give you. Because it is all about recovery of the debt. Can you give us the debt back? Okay, and that is one of the reasons why Lao Tzu could pick up the asset at 5 million euros for 61.5%, because Nordic Mines could not service UniCredit's 40 million euro debt. Okay, and so the question will always be asked as to what is the safety margin at $1,100, and the safety margin should be baked in around about 30-40%. So you have your answer. You have your answer that at the price of $1,100, if you reverse it to the cash cost that is required to produce that kind of safety margin, your cash cost should be around about $650 to $700 for this mine to be bankable at today's gold price. Okay. Now one can say that the gold price will go down to $1,500, $600. That is not how investors do the risk analysis. Okay. Investors will do the risk analysis Institutions will do the risk analysis. Lenders will do the risk analysis on safety margins. Okay, reducing down the risks, modeling the risk in such a way wherein the asset is safe enough to be called bankable. All right. So the focus is on generating safety margins. Okay, at $1,100. All right. So as a result of which the cash cost has to be minimum around about $650 an ounce. Now my simple point is, how the hell are you going to get the $650? It's a very simple question. And the answers that are given up till now is mining related, be it blasting, sorting, infill drilling. Guys, I have absolutely no doubt in my mind that these activities are not going to bring the cash cost to $650. What is going to bring down is the next point that answers Birte's question. Okay, let's get down to what is the basic premises of understanding these so-called John Boyd reports or SRK reports. It is the COG. It is the cutoff grade. Okay, so lower the cutoff grade, okay, higher are your resources, more the cutoff grade, lower your resources. Simple as that, right? Okay, but to understand what cutoff grade is, okay, let's understand what cutoff grade is made up of. It's a ratio. Cutoff grade is nothing but a ratio of operating cost, which is denominated in terms of ore. I will emphasize this again. It's an ore denominated operating cost. Okay, ore denominated operating cost is a business case. Okay, it's not a mining case. It's what happens over the ground. Correct? And then you have the grade denominated revenue. That is, your revenues will certainly higher if your grades are better. Okay, so the trick over here is to understand, it's mathematically putting it. Okay, this is a ratio. So a lot of miners, what they do is they make the denominator, which is the grade, the dependent variable. That is an independent variable. So that is the independent variable to crack. If I crack better grades, I will have better operating costs. Okay, that is what I call as a mining-led business model. What if I just reverse it? Reverse the pyramid. What if at all I make the operating cost as an independent variable and the grade dependent on it? Okay, and that is the core of what this demerger is. That's the core of what this demerger is. Okay, what the demerger is trying to say is that I don't want to bet on grades higher than 1.2, because 1.2 is something which safely mining efficiency can achieve. What are the mining efficiencies which I also covered in my last webinar? A, sorting. Yes, sorting data is very clearly indicating mining efficiency, which can improve mining grades from say 0.8 levels to 1.1 or 1.2. Okay, I will add the third-party contracts. Sorry, no, not the third-party contract. Yeah, the third-party contracts. The third-party contracts signed by Thalquist, which is ridiculous. I mean, if at all you see the cash costs of $1,100 today, okay, of Nordic mines, a huge chunk, okay, comes in. A very critical chunk comes from the inefficiency of the third-party contract that we have signed with Thalquist, and I think that can be improved upon for sure. All right. And if FTR is saying blasting, well, I don't know shit about blasting, but I can tell you blasting, and so be it. But I am pretty sure, okay, that yes, I can take a safe bet in understanding that the mining efficiency can increase the head grades from 0.8, 0.9 to 1.2 or 1.1. Okay. Now my point is that can I have a feasible business model which produces $650 an ounce, or 30-35% margins, okay, at $1,100 an ounce, not 1,300, $1,100 an ounce. All right, that brings me down to the operating costs. So I fix my grade at 1.1, 1.2, which is achievable. Now, having fixed my grade at 1.1, 1.2, how can I achieve an improvement in the operating cost, which can bring down the cash costs of mining? Okay. So when I say demerger, it means demerger of one business into two businesses. Similarly, why don't we demerge the operating costs? What do you mean by demerging of the operating costs? It means operating cost of the mine plus operating cost of the plant. Okay. Now, in my analysis, okay, which I will prove at the EGM, all right, if you demerge, separate the operating cost of the mine from the operating cost of the plant, okay, your blended cash costs will come down to $650 an ounce, because the operating expenses of the plant is outsourced to the strategic investor who wants to buy into the plant. Why does he want to buy into the plant? Why does he want to invest into the operational expenses of the plant? Because he wants the Doreba. That is his business. Why does he want to buy ore from us? Because we are in the business of selling ore. Now, sometime later, or sometime before, I think FTA was also talking about, but it has got a huge cost and all of that. Yes, it will have a cost. Putting up the sorting plant increases the efficiency. But whose efficiency? The processing plant's efficiency. So whose efficiency? The capital efficiency of the investor who's investing into the processing plant. So that part, the investment part of putting the sorting plant in place, is that of the strategic investor and not Liva. So once you outsource the cost of the processing plant to a strategic investor, the residual cash cost that is left for you to operate the plant is where the trick is in terms of figuring out how to get the right valuation of the mine onto the table. It's as simple as that. So Birte's question is answered from the perspective that I would go by the John Arthur stroke legacy stroke SRK study of 0.1 grams to 0.3 grams per ton, because it is baking in the sorting stuff that Peter Kuiper has worked on. And I'm not really interested in the resource statement, because that is just an output. I'm interested in the sorting work, which is producing that output. And for me, taking that sorting work, okay, is a lot more productive because it is over the ground built there. I can see waste rock coming down. I can see the efficiency between productive rock being processed and waste rock getting out of the system. I can see it. And if and there is a cost to putting the sorting plant, that is a financial problem, not a mining problem. And that is where my competencies are. A lot of you guys are asking me, do you have mining competency, mining competency? I don't want mining competency to turn this around. I want financial competency. If suppose somebody asks me, are you going to put $14 million into the processing plant to put the sorting plant? I will say no. They will say, how much do you want to put? I will say zero. But yet get the investment value of $14 million by not putting any money. Okay, guys, it's all about earnings per share. It's all about returns on equity. It's all about showing to the whole world whether Liva is an economical mine to mine, whether it is coming down from an FTR model, whether it is coming down from an Eva Kaiser model, whether it is coming down from Saradi model, or whether it is coming from Pranay Panda's model. The objective is to show to the financial community that LIBOR can be economically mined with certain risks, with not uncertain risks. Okay, but not uncertain risks. Now, let me come down to what I mean by certain risks and uncertain risks. And that is also a part of Birte's question that she had asked. All right. You see, I will post this on over here because you guys can also read it, and then I can explain it to you, and then I'll be finished with my stuff. Okay. You see, so the question that Birte had asked, okay, is, and it's I really appreciate a shareholder going so deep in understanding the questions. The key difference that she pointed out between 1 and 2, okay, between say SRK work and John Arthur, sorry, and FTR look John Bird work, is that SRK work was based more on sorting efficiency data, thus estimating higher grades to John Boyd work, which does not believe in sorting, but instead focus on blasting efficiency. But important to note is that both studies focus on head grades as the independent variable and operating cost as the dependent variable. Okay. The effort in both the studies, which is a mining-led study, okay, is to extract out hidden mining efficiencies for better grades, which earlier between 2011 to 2015 was perhaps not analyzed. I'm assuming that El Dorado, the 10th biggest mine in the world, did not think about blasting, did not think about sorting, did not think about tolling from other mines. I'm pretty sure after spending $40 million and losing $40 million, these are the basics that you will go through before understanding whether you can put another dollar to turn this around. All right. So the mining studies today are concentrating towards finding out hidden mining efficiencies, perhaps which have not been found since the last 6 years. Okay. Now, what Birte was seeking for, she was seeking for the truth in which one is correct. Okay. So the question asked was, which one is correct? Okay. So in doing so, what Birte was doing was she was seeking for is actually which one is more certain to be correct, which one has a higher probability to be correct. Okay. So what she was seeking for is a definition of truth, which is more certain, more probabilistic. Okay. In my opinion, it was John Arthur stroke SRK work done by Legacy Hill Resources. And what was the reason behind it? The reason is the source is known and has higher certainty. Laser sorting is the source. Okay. John Boyd's source is less certain than sorting. Sorting is more certain because it can be statistically modeled with data that has higher confidence levels. Sorting has an added cost. We have already agreed to that. So to bring more certainty to the analytics, to bring more certainty to all this analytics that I've presented, there is a higher cost. To install a sorting plant in the processing plant is an expensive affair. So the higher certainty that I am seeking for, and that Birte is seeking for, and that all the shareholders are seeking for, friends, has a higher cost. So simplistically threading this one out, the one line problem is to create a business model wherein cost of putting up the sorting plant is not from the balance sheet of Nordic Mines. And this is a financial problem, not a mining problem. The analytics of the problem lies in the financial domain and not in the mining domain. What if at all we have a financial case where the sorting cost of putting the sorting plant is not coming in from the books of Nordic Mines, but it is coming from the books of the strategic investor investing in the processing plant, and that's when the demerger is happening. Now, historically, in 2012 and 2013, the 2 years, the Nordic Mines has produced gold in the range of 1,000 kilos. Actual grades that were recorded was something like 1.1 gram tons and 0.9 grams ton, respectively. The grade range was obviously found to be highly uneconomical, even at a gold price of $1,500 ounce range. This was, when the Euro USD exchange rate was far higher than what it is today. As far as I can remember, 2012, 2013, Euro USD was something like 1.35, 1.36. Today it is quoting at around about 1.18. Okay, and not far back it was quoting at 1.03. Right. So a lot of this cash cost nuance, okay, is pretty volatile, and it is pretty much now dependent upon the exchange rate volatility between Euro and the USD. To me as an investor, okay, I would want to make my investment case as certain as possible, okay, reducing down as much of uncertainty from the equation as possible. To put it simply, I want to fix my grade at 1 grams per ton and a model and investment case that makes the mine economical at this head grade level. Because I've made my head grade as a constant at 1.1 grams per ton, which is the dependent variable, I make ore denominated operating cost as an independent variable, which can only be possible if I come out of the mining box and shift the analytics to a completely different box, which can enable me to treat operating cost as a variable independent of head grades. That is the reason why it is important to come out of the mining box and understand whether there is a financial case. I define this box as an asset restructuring box. Demerger, spinning off one company into two companies, is an asset restructuring case. All right. I'm migrating from a mining case to an asset restructuring case. This box of asset restructuring, it kind of directs me or forces me, okay, from understanding mining analytics to understanding business analytics. Okay. And Birte, business analytics is a space which is more certain because you see analytics working for you at a transaction level. Okay, and what is the transaction? The transaction is the demerger transaction. Okay, the outsourcing of the processing plant cost that goes down to the strategic investor, okay, is a transaction which you can see. The efficiency that derives from that transaction is an efficiency that you can measure, you can see. Okay, because you can see and you are more certain, the risk through business analytics is a lot lesser than mining analytics. In a way, what you do is drive your net present value, that is the NPV or the valuation model, okay, in such a way that the business analytics drives the mining analytics and not the other way around. My take, that is Lao Tzu's take, is that the real approach to the problem in hand today is the approach itself. Get out of the mining approach towards figuring out whether there is a financial asset restructuring case which can better your mining case and not the other way around. Okay. There are some numbers, okay, when I say transaction model, when I say outsourcing of cost, okay, from Nordic Mines books to the processing plant, for example, roughly about 1,102 points, I told you that $1,100, okay, should be the threshold gold price at which you should measure your safety margins. And incidentally, 1,100 is also there about the existing cash cost considering the Euro USD exchange rates. All right, and roughly about 1,100 you divide it, about say 550 is on the mining side and 550 on the processing side. So the transaction model in the demerger case is targeting and aiming at outsourcing the $550 of processing plant cost to the strategic investor. And how the economics of that number surfaces out in terms of business analytics is where the demerger arbitrage is between 3% and 38%. That is where the demerger arbitrage is, wherein the sum of the parts is much greater than the whole. That is where when we do 1:1 demerger, when the existing Nordic Mine shareholders gets 1 share of the mine and 1 share of the processing plant, 1 plus 1 is much greater than 5. That is, it is much greater than if you have 1 share of Nordic Mines today. And I don't want to even compare with FTR, because in FTR's case, you're not getting 1 share, you're getting half a share. Okay, and lesser than half a share. All right. So that ends it. Okay. The details of how the transaction happens when you sell the ore, okay, from the mining to the processing plant is covered in my presentation, which will also be covered at the EGM. And that is where the benchmark study of Dynacor Gold Mine comes in. How Dynacor purchases gold from ore, not gold, from the ore from the miners. How does it processes it? What is its business model? Who funds it? Please go through that model, which is there on the website of Dynacor. It is exactly the same model in a different format, okay, as far as the demerger case is concerned, but the founding principles is just the same. So that would end my so-called dissemination today on the demerger case.
Okay. Does anyone have any questions? So
there's only one thing that I want to mention in terms of listing.
yeah.
In the case of, and again, I'm repeating this again and again because I see in a lot of these social media sites, as pointed out by you, Nima, and also NB, that people have assumed that I want to delist. I don't want to delist if NASDAQ does not want to delist. All right. I just want to delist voluntarily if NASDAQ is delisting us forcibly. All right.
Yeah.
That
exactly.
is good. Right. That, okay. Number one. Number two. If in the case where NASDAQ is delisting us forcibly and we are going the demerger model, the mining business will be listed in NASDAQ Dubai, but the processing plant business will ideally be listed in the Scandinavian markets. Okay, it could be the Finnish market, it could be the Norwegian market, it could be one of these two markets. It could also be NASDAQ.
Okay.
Okay. Yeah. Because again, as I said, as somebody asked me a very relevant question, how do you decide which markets to go in? When I say that the mining case, the mining valuation case, all right, is much of better in deeper and more consumable markets, okay, and more liquid markets, all right, institutionally and retail wise, all right, and I would say that Dubai is a zone where you get not only the Gulf liquidity, the oil-driven liquidity, we also get the Indian retail liquidity and the gold mine and the gold community liquidity. Okay, and the institutional liquidity is common to both. So all Indian financial institutions cover up UAE in their global and local cover UAE as one of the geographies. So there's no difference. It's only that UAE is been Dubai is considered because it is just like trading in Nasdaq OMX Sweden. So it is nothing different. But more importantly, the reason why I'm saying that I will have processing, because mining business in my analysis will have a much higher valuation in markets like India and Dubai and Hong Kong and so on and so forth, the Asian markets, whereas the processing plant business will be valued more, okay, in the Scandinavian markets. The scope of this discussion is slightly more complex to be analyzed in this webinar, but suffices to say why Scandinavia and why Nasdaq, because the two assets, each asset will go to a place where it has the highest potential for valuation, right? And why, I will cover that at the EGM. There is a very solid analysis, okay, on that.
All right. Well,
So the processing plant business would be, I mean, my target is Nasdaq OMX, because I'm pretty sure that the processing plant business, the numbers will change. I don't want to, the numbers will change seriously. In the sense the financial statements will change very seriously, right? Because there's a strategic investor who will come down and blah, 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 right? So I'm pretty sure that Nasdaq will not view the processing plant business in the same way it's viewing today, because the numbers will change drastically. So there is a very, very good probability that the processing plant business can be listed back in Nasdaq.
okay. Well, if there's not any more questions, I mean, I think we can put end to this webinar, or do you have something else you want to add?
No, I think the numbers and all will come at the EGM any which way. So I think that's a much better forum to discuss the numbers.
Yeah, that's good. All right then. Well, thank you very much.
Thanks a lot.
Okay. Have a pleasant day. See you. Bye bye.